Welcome to the deep dive. Today, we're going deep into the world of financial institutions. And wow, you weren't kidding about these materials. You handed me a whole textbook on financial analysis.
Yeah, it's pretty dense stuff. But don't worry, we'll break it down together. We'll pull out the key takeaways, the stuff that really matters for understanding these complex organizations.
Banks, insurance companies, the whole shebang. I'm already intrigued. So let's get started. What makes a financial institution different from, say, a company that makes shoes?
Well, the key difference lies in their focus. Financial institutions are all about financial assets.
Financial assets.
Right, so instead of dealing with tangible goods, like shoes, they're dealing with money itself. Think loans, securities, derivatives, and it's a whole different ballgame.
Okay, so they're the money movers, the financial puppet masters. But why is that so different? Why should we care more about them than, say, a shoe company?
Because their impact is much broader. You see, if a shoe company goes bankrupt, it's unfortunate, but the world keeps spinning. But if a major financial institution fails, well, that can trigger a domino effect across the entire economy.
Oh, wow. Okay, that's a bit more serious than a shoe shortage.
Exactly. And that's what we call systemic risk. Their activities are so deeply intertwined with every aspect of the economy that a failure could be catastrophic.
Okay, suddenly I'm paying very close attention. So I'm guessing that explains why they're under such intense scrutiny, right? All those regulations. Who's in charge of keeping things from, going haywire?
Well, on a global scale, we have the Basel Committee on Banking Supervision.
Basel Committee.
Yeah, they're kind of like the referees, trying to keep the game fair and prevent a financial meltdown. They developed a framework called Basel III, which sets these minimum standards for things like capital adequacy and liquidity.
Capital adequacy, liquidity, those sound important.
They are. Think of capital adequacy like a bank safety net.
Hmm.
It's the amount of equity capital they hold, compared to their assets. It acts as a cushion to absorb potential losses.
Got it.
And then liquidity, well, that's all about having enough cash or easily convertible assets on hand to meet short-term obligations. It's like having a rainy day fund.
So basically making sure they can actually pay their bills, right?
Exactly. You need that cushion when things get rough.
Okay, so Basel III is the rule book, making sure these institutions are playing it safe. But what about analyzing a specific bank? Like, where do we even begin?
Well, there's this handy acronym, CAMELS.
CAMELS.
Yeah, it stands for capital adequacy, asset quality, management capabilities, earnings efficiency, liquidity position, and sensitivity to market risk. It's a framework for assessing a bank's overall health and stability.
I love a good acronym. So we've got our checklist, CAMELS. Let's start with C, capital adequacy. We touched on it earlier, but how do we actually measure that cushion?
Well, banks have to calculate what's called risk-weighted assets.
Risk-weighted assets.
Yeah, so basically, the riskier their loans and investments are, the higher the weighting. The higher the weighting, the more capital they need to hold against it.
So like a mortgage on a shaky investment property would require a bigger cushion than a safe bet, like a family home in a stable neighborhood.
Exactly. More risk equals a bigger cushion needed.
That makes sense. Now, our sources mention Citigroup as a real-world example. Obviously, they're a huge player in the financial world. What can you tell me about their capital adequacy?
Okay, so according to their financial reports, Citigroup's Common Equity Tier 1 capital ratio, which is a key measure of capital adequacy, stood at 14.35% at the end of 2016.
14.35%. What does that tell us? Is that good, bad, average?
Well, that's actually well above the minimum requirement set by Basel III, which suggests they've got a pretty solid capital cushion to absorb potential losses.
So on the C for CAMELS, they seem to be doing all right.
So far, so good.
Okay, that's reassuring. Now, what about A, asset quality? What are we looking for there?
Asset quality is all about the health of a bank's loans and investments. We want to know, are their borrowers creditworthy? Are they likely to repay their loans? And how well has the bank accounted for potential defaults?
So essentially, are they taking smart risks?
Yeah, that's a good way to put it. We're trying to gauge how risky their assets are and how prepared they are for things to go south.
So what can you tell me about Citigroup in this area?
Well, our sources provide a pretty detailed breakdown of Citigroup's assets, showing the mix between liquid assets, investments, and loans. It seems their loan portfolio is divided into consumer loans and corporate loans.
So everything from mortgages and car loans to big business loans, a pretty diverse mix.
Right.
What does that tell us about their risk profile?
Well, we need to dig a little deeper into the specifics of their loan portfolio to really get a handle on the risk. But on the surface, it looks like they've got a fairly diverse mix. which, can be a good thing.
Diversification spreading the risk.
Exactly.
Okay, so we need to look at those individual pieces, see how healthy they are, and where the potential problems might be, right?
Precisely. And that's where we'll start getting into some really interesting details.
Well, I'm hooked. Let's keep digging. Okay, so we're back to Citigroup and their loan portfolio. We know it's a mix of consumer and corporate loans, but how do we actually figure out how healthy those loans are?
One way to do that is to look at what's called the allowance for loan losses.
Allowance for loan
Yeah.
losses.
It's basically a reserve that banks set aside to cover potential losses from loans that might go bad. Think of it like a rainy day fund specifically for bad loans.
So the bigger the allowance, the more prepared they are for potential defaults, right?
Generally speaking, yeah. A larger allowance usually suggests they're being cautious, setting aside a bigger buffer against potential losses. But it's not just about the size of the allowance. We also need to look at how it compares to the overall size of their loan portfolio.
Okay, so context is key. So what does that comparison tell us about Citigroup?
Well, our sources show that at the end of 2016, Citigroup had an allowance for loan losses of, roughly 2.4% of their total loans.
2.4%. Is that good? Bad. What's the benchmark here?
Well, there's no magic number. It really depends on the specific bank, the types of loans they make, and the overall economic environment. But we can compare that 2.4% to, say, other banks in their peer group, or to their historical allowance ratios. That can give us a sense of whether they're being more or less conservative than usual.
Okay, so we need to see the bigger picture. What else should we be looking at when we're thinking about their loan portfolio?
Another important metric is the net charge-off ratio. This one measures the actual loan losses they've incurred relative to their average loans outstanding.
So like how much they're actually losing on those loans.
Exactly. It's a backward-looking indicator. It gives us a sense of their historical loss experience.
So lower is better, I assume.
Absolutely. A lower net charge-off ratio means they've had fewer losses, which suggests their underwriting standards are sound, and their loan portfolio is performing well.
Okay, so we want to see a healthy allowance for loan losses A and D, a low net charge-off ratio. Signs they're managing those credit risks well. Now, what about those off-balance sheet items we were talking about earlier? How do those fit into the picture?
Yes. Off-balance sheet items. Those are the assets and liabilities that don't show up on the main balance sheet, but they can still impact a bank's risk profile.
Sneaky. So we need to be extra vigilant.
Yes, definitely. They can be a hidden source of risk. We need to be aware of those.
Okay, so remind me, what kinds of things are we talking about here? Loan commitments, derivatives, special purpose entities, right? Give me the rundown on those potential risks.
Sure. So loan commitments are essentially promises to lend money in the future. They aren't actual loans yet, but they do represent a potential future obligation. And that could affect a bank's liquidity and capital adequacy down the line.
So even though they're not on the balance sheet yet, we still need to keep them in mind.
Got it. What about derivatives? I know those could be pretty complicated.
Yeah, derivatives, those are a bit more complex. They're financial contracts that derive their value from an underlying asset, like a stock, a bond, or a commodity.
I kind of remember those from finance class, vaguely.
Right, so they can be used for hedging purposes to manage risk, or they can be used for speculative purposes, trying to profit from market movements.
Okay. So they can be a bit of a double-edged sword. Useful for managing risk, but also potentially dangerous if not used carefully.
Exactly. Derivatives are complex instruments. It's super important to understand how banks are using them and what the potential risks are.
Okay, derivatives got to be extra careful with those. What about those special purpose entities?
Special purpose entities. Right. These are often created by banks to isolate certain assets or liabilities from the main balance sheet.
Okay, why would they do that?
Well, they can be used for a variety of reasons, but one common purpose is securitization. Securitization, that rings a bell.
It's basically pooling assets together, like mortgages, for example, and selling them off as securities to investors.
Got it. So, can this be a way for banks to reduce risk?
Yeah, potentially. It can be a way to reduce risk and free up capital, but it can also create new risks if those securitized assets go sour.
So those special purpose entities, they can be used to shift risk off of a bank's balance sheet. But that doesn't mean the risk disappears.
Exactly. You just move somewhere else.
Yeah.
And that's why it's so important to look beyond the balance sheet and understand the potential risks that might be lurking in those special purpose entities.
Got it. Off-balance sheet items, we need to be on high alert. Okay, we've covered capital adequacy, asset quality, and those tricky off-balance sheet items. That brings us to M, management capabilities. How do we assess the quality of a bank's management team?
That's a great question. And it can be a bit more subjective than analyzing hard financial numbers. But we can look for clues, in their public disclosures, their actions, their overall track record.
So it's a bit like being a detective, piecing together the evidence to get a sense of their competence, their ethics, right?
Exactly. We need to look for consistency. Yeah, consistency in their actions, their messaging. Do they walk the talk? Are they making sound decisions that align with their stated goals and values?
So what about Citigroup's management team? Any red flags or reasons for optimism?
Well, their track record is definitely something to consider. They've been through some pretty turbulent times in recent years, including the 2008 financial crisis. And remember, they were heavily involved in that.
Right. They were one of the banks that received a massive government bailout.
Exactly. So we need to think about how they navigated those challenges. What lessons did they learn? Have they taken steps to improve their risk management practices and, strengthen their financial position?
So have they learned from their mistakes? Are they taking steps to prevent history from repeating itself?
Yeah, that's what we want to see. What about their communication with investors? Are they being transparent and open about their challenges and opportunities?
No sugarcoating. We want the truth, the whole truth, and nothing but the truth.
Exactly. Transparency is crucial. It builds trust and confidence with investors and regulators. We want to see clear and concise communication, stuff that avoids all that jargon and spin.
So no corporate mumbo jumbo.
Exactly. We want the straight facts. And we also want to see evidence that they're holding themselves accountable for their performance. Are they meeting their targets? Are they addressing their weaknesses? These are all signs of a strong and effective management team.
Okay, so track record, transparency, accountability, those are all key factors in assessing those management capabilities. What about their corporate governance practices? Are they following those best practices in terms of board independence, executive compensation, risk management oversight?
Corporate governance. Yeah, that's the framework that guides a company's decision-making, their behavior. It's essential for making sure that the company is run ethically, responsibly, and in the best interests of its shareholders.
So good corporate governance, that's a sign that a company is taking these responsibilities seriously.
Absolutely. We want to see a board of directors that's independent and, that provides effective oversight of management. We want to see executive compensation that's aligned with long-term value creation. And we want to see those robust risk management systems in place to identify and mitigate potential risks.
So it's all about checks and balances, making sure no one has too much power and that the company is acting in everyone's best interest.
Exactly.
Okay, so strong leadership, transparent communication, good corporate governance, and a solid track record. All signs of a management team that knows what they're doing and can steer the ship in the right direction.
Precisely. And while we can't know for certain what's going on behind closed doors, these factors can give us some valuable insights into the quality of a bank's management team.
Okay, so we've got M for management covered. Now let's move on to E for earnings. What are we looking for when we're analyzing a bank's earnings?
Well, we want to see strong and sustainable earnings growth, not just a one-time bump in profits.
So not just a flash in the pan.
Right. We want to see earnings that are driven by those core operations, like making loans, taking deposits, providing financial services, and earnings that are sustainable over the long term.
Consistency and sustainability are key.
Absolutely. We don't want to see earnings that are driven by one-time gains or accounting gimmicks or excessive risk-taking.
Right, because those types of earnings are often unreliable. They don't last.
Exactly. We want those solid, reliable earnings, the kind that come from smart business practices and a sustainable model.
So how do we assess the quality of a bank's earnings?
We need to break down their income statement, really understand where those profits are coming from. Are they mainly coming from net interest income?
Net interest income.
Yeah, the difference between what they earn on loans and what they pay on deposits. Or are they relying heavily on trading income or fee income?
So different sources of income, different levels of quality.
Exactly. Net interest income, that's generally considered more stable and predictable than trading income or fee income, which can be way more volatile.
Ah, got it. So if a bank has a lot of that net interest income, that's a good sign.
Generally, yeah. It suggests that their profits are driven by their core lending business, and that's usually considered less risky than, say, trading or investment banking activities.
Makes sense. So when we're analyzing earnings, we're looking at both quantity and quality. Strong, sustainable earnings from doing what banks are supposed to do.
You got it. High-quality earnings are a great sign of a healthy and resilient bank, the kind that can weather those economic storms and keep on generating profits for its shareholders.
Okay, earnings check. Another important element of CAMELS covered. Now let's move on to L for liquidity. What exactly does liquidity mean when we're talking about banks?
Liquidity is all about a bank's ability to meet its short-term financial obligations as they come due, to pay its bills.
Keeping the lights on.
Right. Liquidity is super important for any business, but for banks, it's especially critical.
I'm sensing a but coming.
Well, because banks operate on this fractional reserve system, meaning they only hold a small fraction of their deposits in reserve,
The rest is.
lent out, invested, put to work.
Ah, okay. So they're essentially borrowing short-term from depositors and lending long-term to borrowers.
Exactly. And that creates a mismatch in maturities, which can expose them to liquidity risk.
So what happens if everyone wants their money back at the same time?
That's the problem. If depositors suddenly lose confidence in the bank, for whatever reason, and they all demand their money back at once, the bank needs to have enough liquid assets on hand to meet those withdrawals.
Otherwise, it's a bank run. Not good.
Exactly. Liquidity risk, it's one of the most critical risks that banks face. And, it's a major focus for regulators.
Okay, so how do we figure out how good a bank's liquidity position is?
Well, we look at a bunch of metrics, things like their liquidity coverage ratio, their net stable funding ratio, their loan-to-deposit ratio.
Those ratios again.
Yeah, they're important. The liquidity coverage ratio, that measures a bank's ability to withstand a 30-day stress scenario. Can they still meet their obligations even if funding dries up?
So higher is better.
You got it. Higher ratio means a stronger liquidity position. Then there's the net stable funding ratio. That looks at the stability of their funding sources over a longer time horizon.
So, are they reliant on those flighty short-term funds, or do they have stable long-term funding?
Exactly. And again, a higher ratio is better because it indicates a more stable funding base. And then there's the loan-to-deposit ratio.
Loan-to-deposit ratio. What's that one again?
That one measures the proportion of their deposits that are tied up in loans. So a lower ratio there indicates a more liquid position. They've got a bigger cushion of deposits that aren't lent out.
Okay, so lots of different ratios to keep track of. But basically, when we're analyzing liquidity, we're looking for those healthy ratios and a diversified funding base. All signs of a bank that can handle a little bit of a financial storm, right?
You got it. Liquidity, it's the lifeblood of a bank. Absolutely essential for survival.
Okay, liquidity check. Now let's finish up our CAMELS analysis with the final piece. Sensitivity to market risk.
All right, market risk. So this refers to the potential for losses from changes in, market conditions. Things like interest rates, exchange rates, commodity prices, and equity prices.
The stuff we see on the news every day.
Exactly. Those are all external factors that are pretty much beyond the bank's control. But they can have a big impact on their financial performance.
So banks are at the mercy of the markets to some extent.
To some extent, yeah. Banks are exposed to market risk in a lot of different ways, through their trading activities, their investment portfolios, even their lending activities.
Okay, so how do we actually assess their sensitivity to these market risks? What do we look at?
We analyze their exposure to different types of market risk, their hedging strategies, and their stress testing procedures.
Hedging, isn't that like using financial instruments to offset potential losses from those market movements?
Exactly. Hedging can be a really effective way to manage that market risk, but it's not a perfect solution. And then there's stress testing, which involves simulating those adverse market scenarios, to see how the bank would hold up under those conditions.
So stress testing is like a fire drill for banks, right?
Yeah, that's a good way to put it. It helps them prepare for the worst-case scenario.
Hopefully they never have to use it, but good to be prepared.
Definitely. Stress testing, it's a crucial tool for managing market risk. And regulators require banks to do these stress tests on a regular basis, to assess their resilience.
Okay, makes sense. So when we're looking at sensitivity to market risk, we want to see that well-defined risk management framework, those effective hedging strategies, and those robust stress testing procedures. All signs that a bank is taking this market risk thing seriously.
Exactly. Managing market risk, it's an ongoing challenge for banks, but it's crucial for their long-term success.
Okay, we've covered so much ground with CAMELS. It's a really comprehensive framework for analyzing banks. But our sources also mention a few additional factors that we should keep in mind when we're looking at a bank like Citigroup. What else should we be paying attention to?
Right. CAMELS is a great starting point, for sure. But it doesn't tell the whole story. We also need to think about things like government support, segment information, and currency exposure.
Okay, let's unpack those. Let's start with government support. Why is that important?
Well, banks are what we call systemically important institutions. Their failure can have those ripple effects throughout the entire economy. So governments often provide implicit or explicit support to banks to try to prevent them from collapsing.
So if a bank is seen as having strong government support, it might be viewed as less risky.
Exactly. Investors might be more willing to lend to them, at lower rates, and regulators might be less likely to impose those stringent capital requirements.
Ah, so it can be a real advantage.
It can be, but it's important to remember that government support isn't a guarantee, and it can also create what we call moral hazard.
Moral hazard.
Yeah, meaning that banks might take on more risk if they believe they're going to get bailed out.
Ah, so a bit of a safety net can sometimes encourage risky behavior. Okay, what about that segment information? Why is that important?
Segment information, that breaks down a bank's financial performance by, business line or geographic region. It gives us a more granular view of their operations, helps us identify areas of strength and weakness.
It's like looking under the hood, seeing how all the different parts of the engine are running.
Exactly. Segment information can be really valuable for understanding a bank's overall risk profile and profitability.
So, for example, if a bank is super concentrated in a particular business line or a specific geographic region, that could be risky, right?
Yeah, absolutely. If that segment were to experience a downturn, the bank could be in trouble.
Diversification is key, yet again.
Always. And segment information helps us see how diversified they really are.
Got it. Segment information, it's all about that detailed picture of a bank's operations and their risk profile. Now, what about currency exposure? Why is that important?
Well, a lot of banks operate globally, which means they're exposed to fluctuations in currency exchange rates. And, those fluctuations can impact their earnings and capital adequacy, especially if they've got a lot of assets or liabilities in foreign currencies.
So, like, if a bank has a lot of euro-denominated loans and the euro weakens against the dollar, their profits could take a hit.
Exactly. And, a bank with a lot of dollar-denominated debt could see its capital adequacy erode if the dollar strengthens against other currencies.
Ah, so it can go both ways.
It can. Currency exposure, it's another risk factor that we need to think about.
Especially for those big global banks. Okay, so we've covered so much about analyzing banks. We've got our CAMELS framework, plus all these extra considerations to keep in mind. Now, let's switch gears and talk about insurance companies. How does the analysis change when we're looking at those types of financial institutions?
Insurance companies. Yeah, they're fascinating. They play such a unique role in the financial ecosystem. And analyzing them, well, it does require a slightly different approach than analyzing banks.
Okay, I'm ready for a new challenge. Bring on the insurance giants. Okay, so we're switching gears from banks to insurance companies. I know there are different types of insurance companies, like property and casualty versus life and health. So where do we even begin with these?
It's a good place to start understanding the different types, because the analysis does vary depending on what kind of insurance they're providing.
Makes sense.
Property and casualty, or P&C, it's all about protecting against those unexpected events. Things like car accidents or house fires.
Yeah.
Life and health, or LNH, that's more about planning for the future. Things like life insurance or retirement annuities.
So P&C, that's for sudden, unpredictable events, while LNH is more, well, long-term and predictable.
Exactly. And that fundamental difference really shapes how we analyze them. For P&C, liquidity is super important. They need to have enough cash on hand to pay out those claims when something happens. So their investment strategies, they tend to be more conservative.
I see.
Focused on, preserving capital and generating steady income.
They need to be ready when disaster strikes. It makes sense. You wouldn't want to be caught short when those claims come rolling in. Now, what about their earnings? How do we figure out how profitable they are?
One of the key metrics we look at for P&C insurers is the combined ratio.
Combined ratio.
Yeah. It's a measure of their underwriting profitability. Essentially, how much they're paying out in claims and expenses compared to the premiums they're collecting.
So less paying out, more taking in.
Basically, a combined ratio that's below 100%, that means they're making money from their core insurance operations.
Ah, so lower is better then.
Absolutely. The lower the combined ratio, the better. It indicates that they're effectively managing risk, pricing their policies appropriately and keeping their costs under control.
All good signs. Okay, so combined ratio, that's a big one for P&C insurers. What about loss reserves? Those are the estimated amounts they set aside to cover future claims, right? How do we analyze those?
Loss reserves, yeah, those are critical, a critical part of a PNC insurer's balance sheet because, well, those future claims, they can be pretty substantial and unpredictable too.
Makes sense.
We need to understand how they're estimating those reserves. What assumptions are they making, and are those assumptions reasonable?
So it's kind of like detective work, right? Looking for clues that might suggest they're being too optimistic or, too pessimistic in their estimates.
Exactly, got to dig a little deeper. If their loss reserves are too low, they could have some unpleasant surprises down the line, and that could really hurt their earnings and their stock price.
I see. So another crucial area where we need to be paying attention. Okay, so we've touched on some key things to consider when analyzing P&C insurers. Let's switch gears and talk about L&H insurers. What are the main differences?
Right, so L&H insurers, as we mentioned, they've got a much longer time horizon to work with. Their policies can be enforced for decades. So their investment strategies are different. They can afford to take on a bit more risk in their portfolios.
Because they have more time to recover if things go bad.
Exactly. They're looking for those higher returns over the long term.
Makes sense. Now, what about their earnings? Are there any specific metrics we should be paying attention to there?
Well, one key metric for L&H insurers is the benefit ratio.
Benefit ratio.
Yeah, it measures the benefits paid out relative to the premiums collected.
So it's kind of similar to the combined ratio for P&C insurers, but just focused on that benefit side.
Exactly. A lower benefit ratio means they're managing those claims well, keeping their costs down.
Yeah.
We also look at their investment income, how much that's contributing to their overall profitability. And we have to assess the risks they're taking in their investment portfolios. Are they aligned with their long-term liabilities?
Right, because those long-term liabilities, those can be huge. They have to make sure those investments will generate enough return to cover those obligations way down the line.
Absolutely. And, with interest rates being so low these days, it's tough for L&H insurers to find those investments that will provide enough return without taking on too much risk.
A real balancing act. Okay, so we've got benefit ratio, investment income, overall investment risk. Those are some of the key factors to consider when we're looking at L&H insurers.
Precisely. And of course, we also need to factor in things like the regulatory environment they're operating in, the competitive landscape, and the overall economic outlook.
It sounds like analyzing insurance companies, it requires a pretty deep understanding, not just of the numbers, but of the whole industry and, well, the entire economy.
You're right. It's complex. It's a multifaceted analysis that needs both quantitative and qualitative skills.
Well, I have to say this deep dive has been eye-opening. I had no idea just how complex the financial world really is. From banks to insurance companies, it's been a whirlwind of information.
We've only just scratched the surface. But hopefully this is giving you a better understanding of these really important players in the global economy.
I feel much more equipped to navigate this world now. Armed with that CAMELS framework, those extra things to consider, and, well, a whole new appreciation for insurance.
Great. And remember, critical thinking is essential. Don't just take those numbers at face value. You've got to dig deeper. Ask those tough questions. Challenge those assumptions. That's what makes a true financial analyst.
Great advice. Thanks for joining me on this fascinating deep dive into the world of financial institutions.
It's been my pleasure. Until next time, keep learning, keep exploring, keep diving deep.
And to you, our listener, we hope you enjoyed this deep dive. We've covered a lot, but as we said, there's always more to learn. So keep those questions coming, keep seeking out knowledge, and keep diving deep into those topics that really fascinate you. Until next time, happy learning.